For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
That's right. That's my favorite podcast. How did you know? How did I know? It's Managing Your Financial Future. Johnny Dean here. Welcome once again to the show. We've got a lot of good stuff to cover today. Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. Welcome to you. Thanks for being here.
You're very welcome. Good morning, good afternoon, good evening. We don't know what time it is.
No, I don't even know. I don't know what the real time is right now. But I do know this is always interesting to me. Well, it's interesting, but this is the way the pattern happens because we record these and they have a compliance process to go through. And so it takes usually a couple 3 weeks between the time we record these podcasts and then the time that it actually goes out. And then when people listen to it, if they don't listen to it right away, it can take another week. So sometimes we get questions from people about a podcast that, and I have to go back. I said, well, what did we talk about? What was that? So it was funny to me that we had a discussion about 401k plans.
With Ara.
Yeah, it was I forget. It may have been January. Anyway, so we just started getting people asking questions about that, and so I have to go back and see, well, what in the heck did we talk about? But because you think I pay attention every single time, I do, but then we move on. So one of the questions that came in was to me. Actually, there were 2 questions on this when we were talking about 401k plans. And it had not occurred to me that we should talk about it on this show. And it has to do with 401k plan loans. Is it a good idea to take a 401k plan loan or something like that? And I went back to our archive to see, well, did we ever? I know we've talked about 401ks a number of times. We talked about 401k strategies. Things to do in your 401k, how they work and all that. But I did not see anything going back 4 or 5 years about us talking about a 401k loan. And so I thought, well, we got a couple of questions on it. This is on people's minds. Now, I know by the time this one airs, it'll be a month or so after they ask the question. But I try to let people know that if you do ask us questions, it's going to take a little bit of time to get to them here on the show. But I want to talk with you about this, Professor Plum, and it may not take up the entire time. And if not, there was another question on target date funds, which if we get to it today, fine. If not, we'll save it for another show. But it does all have to do with the 401ks. So I want to go over this with you for just a little bit or longer, depending on how this plays out. A 401k loan. There are many people out there who didn't even know that there is a 401k loan. Talk for just a second, Professor Plum, about just the most generic nature of a 401k loan and how, you don't have to get into the details yet, but how they work.
Well, first off, your plan has to offer them. So a lot of people don't know about them because maybe their plan doesn't even offer them. But if you have a 401k plan at work, and one of the options that are available from it is the ability to borrow money from it, you can, at different times in your life, take a loan from your 401k. You can borrow up to 50% of your vested balance or $50,000, whichever is less. You can't, if you've got, $500,000 in your 401k, you can't take a $250,000 loan. On the other hand, if you only got $25,000, you can't take a $25,000 loan either. Mm-hmm. It's 50% of the balance up to $50,000. The loan has to be repaid back within a 5-year period of time. Now, there are some outliers for home purchases, but very few 401ks actually go that far into it. In fact, I've never seen one, but for the most part, there has to be a 5-year amortized repayment schedule. Most companies are only set up to take that payment through salary deferral. They're not going to bill you for it. They're just going to take it from your paycheck, however often you're paid. And the interest rate, it's relatively competitive-ish. It's probably in the 6 to 7% range right now. I haven't looked, but it's about in that area. It's not going to be 0. It's not going to be 29.9. I hope not. But the big issue is it's a 5-year what amortize means that it's principal and interest. It's not an interest-only loan for 5 years where you pay it back at the end. So it's just a matter of it's a payment. And so determining whether or not a 401k loan is good or bad, you really have to delve into more of the person and debt in general for that person.
Yeah, and I want to get into that. We are going to cover that after I think we maybe talk a little bit more about each of the things that you just mentioned right here. A 401k loan. Now, we should say right off the bat, Professor, and you can speak for yourself, but from my experience has been that people should not generally consider a 401k loan unless there are some circumstances that are unavoidable, that this is like one of your last places to look. Would you agree with that, just that statement?
I guess as a blanket statement, I mean, we'll just start off, you need to know where my biases are, where my thought process is to understand where my comments are coming from. I have used 401k loans in the past. And I had other loan opportunities available to me. I just felt that the 401k one at that moment was the more opportunistic one for me. But it goes back into it's not right for everybody. They're not bad. I mean, some people in the journalistic world never do it. It's horrible. Don't take away. Don't use your 401k as a loan source now. Well, it's a nice idea, but it's not always practical. Other people are, they're the greatest thing in the world. There are some misconceptions. And they say they're the greatest thing in the world because you're paying yourself back. And one of the misconceptions is that the money is still invested and you're just paying yourself back, so you're making that on top of what everything else is in the 401k is doing. That's not necessarily the case. So how a 401k loan works, let's say that I have $100,000 or more in my 401k and I want to take out a loan for $50,000. What is that 401k doing for you? Are they just forwarding you $50,000 and leaving your $100,000 invested in the growth investments or whatever investments you'd selected before? No, they're selling off $50,000 of your 401k and sending it to you in the form of a loan that is like a bond in that respect. So it shows up in the 401k as an asset. That loan to you is an asset of your 401k. Yes, you're paying yourself back, whatever the interest is. That interest is not deductible, so you're paying taxes on the money that's going back into your 401k on the interest. Is that a good or a bad thing? What's the market doing during that period of time? Now, if you had borrowed money from your 401k in 2007 and the market was a little flat and then went down 50% in 2008-9, the fact that your 50,000, this example, that 50,000 was not in the market meant that it didn't lose any money. And then as the payment came in each paycheck, it was being reinvested back into the growth investments you have. That was a great way to do things. You did really, really well with it. On the other hand, on any up market over the past several years where the markets have been up 20% at times, you missed out on that increase in the value. So that asset, that loan value that's outstanding, is not invested in anything other than the interest that you're paying back to it. So you're missing out on the market return, good or bad.
Yeah.
And so it's a matter of, that's one misconception that people think, well, I'm just paying myself back and I'm not missing out on anything. Potentially, you're missing out on what that money could have done for you anyway. So let's say that it was going to earn 6, 7, 8% over the 5-year period of time that you were paying back your 6, 7, 8%. Well, they would have done that 6 or 7%, 8%, even without you paying it back, but you forced it, so you didn't get anywhere. It cost you that. But that's just one way to look at it. The real thing to look at is debt and how you or what's going on in your life, the way debt works. I know people that are habitual in debt, that if their credit card isn't maxed out, there's something going wrong, because they're always maxed out. And if they were to take a loan from anywhere else, an equity line, a 401k loan, a loan from anything else to pay off their credit cards, which are at just ridiculous 18 plus, 19, 20% plus rates, they would pay off the credit cards, have the loan from the 401k, and within a year, they probably have those credit cards maxed out again. that was not a good use of the 401k loan. On the other hand, there are people that get caught short and they need, and so their choices are, do I use a credit card where my interest rate is 18.9% or higher, or do I use a 401k loan and miss out on some potential upside and pay 6-7%?
Yeah.
But the other thing is, a credit card, I mean, if I have a $10,000 credit card payment, what's the minimum payment? A couple $100 a month? The 401k is going to be more, probably, as a payment.
Yeah, now
because it's a 5-year repayment schedule.
Now, just for a moment here, when we're talking about paying it back, you said, of course, that it's amortized over 5 years. Some loans, and I'm not saying on a 401k loan, but a bank loan, oftentimes you can just, pay it back. Let's say somebody in your example wanted to use that $50,000 401k loan as a bridge loan, until a year from now when they're going to sell a home or whatever it is. And now they say, well, okay, I've got my $50,000 back, plus interest. It's been a year. Can I just repay it all in one lump sum, or does it have to all come out of my paycheck month by month?
It depends on the plan. What I have seen most common is that if you have that $10,000 loan and you've been making payments on it, now you owe $7,000. And let's say you came into $5,000 and said, well, I want to pay $5,000 now. Most 401ks are not going to accept just a check for $5,000 and still have the loan outstanding with a lower balance. They basically say, continue the payments or pay it off in full. Those are your options. That's what I've seen is very common. So until you have enough money to pay it off in full, they don't accept a check coming in.
Yeah.
That's not a rule that has to be followed from the IRS, I don't believe. But most plans don't play around with partial payments and things of that nature.
Well,
they say, just continue the salary deferral till you have enough to pay it off. Then, yeah. But most of the time you can pay it off early if it's in full.
Okay, so they don't have to deal with the bookkeeping and all that stuff, because this is it takes a little bit of extra, I don't know, number crunching and all that stuff. Somebody has to look over this stuff. Now, so to recap what you were saying on this, I'm going to go back to your $100,000 401k and you wanted to take $50,000 loan. When you take that $50,000 loan and you do whatever it is you do with it, as you said, Professor Plum, your balance is now down to $50,000.
Your invested balance in the 401k.
Yes, not your you.
My 401k still says it has $100,000 in it. The $50,000 is invested in XYZ mutual fund, where 100% used to be in the XYZ mutual fund. $50,000 is in the XYZ mutual fund, and $50,000 is in a loan to me.
Yes, that I am paying back. Yes. And you said something significant too. When you're paying this back, and this is one of the things that people say, well, okay, but I'm paying myself 6% interest. Yeah, it's over 5 years, let's say, but I'm paying myself back. But what you said is you're paying it back. That interest is not deductible. You are paying taxes on that interest that you're paying, however much it is per month. Or every 2 weeks, right, whatever it is.
The payment is an after-tax payment going into the plan.
Yes. Now, when you take that money out, though, Professor Plum, you can't make the argument that, well, I paid that interest is tax free because I used post-tax dollars on that. Professor, you're paying tax going in on the loan to repay it. For interest, and you're paying tax when you take that earnings tax
well,
out.
Just think, remember, this is an investment. This loan to you now is an investment of the plan. If the plan had taken that money and you had bought a 5-year bond from a big company, a 5-year amortized bond, not that there's any of those out there, but and the bond was paying the payment back to the 401k. First off, do you get to not pay tax on that interest that's being paid into the plan? No, You don't pay tax on it now. It gets deferred till later. So it's an asset of the plan. And the fact that you've already taken the money out and then putting it back in, it's all after tax because you're not taxed on the money coming out for the loan either. And, so it goes back in. It's just one of the fun parts of 401ks, and goes back to what should you or should you not use the 401k loan. The big misconception there is, yes, you are paying yourself back. Yes, it's after tax. Yes, that money will come out ultimately. And the payment back into the plan is in addition to any 401k contribution that you may or may not be making after you take out the loan. Sometimes when you take a loan out, people say, well, if I take that $50,000 loan out, my payment's roughly $1,000 a month. I can't afford to continue to make payments as a contribution, a deductible contribution, or to the plan. So I'm going to cut back on my contribution and just pay back the loan. Well, that's one way to afford it.
But you're missing out on the dollar cost averaging aspect of it from that.
Well, yes
standpoint.
and no, because the payment that goes back in, that $1,000 a month,
is dollar
roughly,
cost averaging,
is going back into the other investments. So you are kind of dollar cost averaging in then. But again, the $50,000 is not earning anything other than what you're feeding it. It is not earning what the markets could have been earning, which is either a good or a bad thing, depending upon the time horizon.
Now, let me bring something else up into this. Another thing that you hadn't mentioned yet, but we're going to, which is that you have a 5-year schedule, let's say, to pay it back, and it's going to come out of your salary every 2 weeks, month, whatever, however often you get paid, a certain amount of money. You owe $10,000, $20,000, I don't know, however much it is. And let's say you terminate employment for whatever reason. You retire, you get fired, you get laid off, you quit, whatever reason it is, you still have a balance due on that 401k, $10,000, $20,000, $50,000, whatever you happen to take out and whatever you still owe. Professor Plum, if it's a salary deferral retirement, a repayment plan, what happens when you leave employment for whatever reason?
How'd you know I was going to talk about this at some point? But it is an issue because one of the factors when you're looking at taking a 401k loan is, will you be there for the entire length of the repayment? Are you going to be there for the 5 years? Because it does have a potential negative effect if you leave employment either by your choice or maybe not your choice, and the loan is outstanding. If you can repay it when you leave, that's one thing. So if you took that $50,000 loan out and a couple of years later you're down to $30,000 on the loan, and you decide either to retire or they decide to retire you, terminate you, that $30,000 loan is going to be due and payable. As soon as it's usually a quarter, sometimes a semi-annual issue, that once you go past not making a payment for 3 months, 6 months, it's in default, and they will issue it as a distribution to you. So you don't get any money because they're just canceling the loan at that point. But that, in this example, $30,000 distribution, if you're less than 59.5 or less than 55 when you terminated, not only is that going to be a taxable event to you at that time, because technically the money is at that point coming out of the plan, it's going to be subject to a penalty because you're not old enough to take a distribution from the plan. So either you pay it back in full or you face paying taxes and penalties if you're underage. Taxes for sure, penalties if you're not old enough.
Yeah,
Okay, so when you're looking at taking that loan, there's several things you got to look at. And one of the things you have to look at is, what is the likelihood I'm going to be employed with this employer for the life of that potential loan?
So your choice would be write a check. Let's say you owe $30,000 still on this loan. Doesn't matter, whatever it is. But let's say it's $30,000. You leave the company. You either write a check, I guess, for $30,000 so that loan is paid off, or within a certain amount of time, 6 months, 3 months, whatever it happens to be, the loan will be considered in default, and it's no longer a loan to you. The remaining balance is going to be treated as if they just wrote you a check.
A distribution.
A distribution. And that distribution, depending on your age, I'm just recapping what you said.
Yes.
The distribution, depending on your age, it'll be taxable to you, but it may also be add a 10% penalty for being under age 59 and a half, because now you took a distribution, and if you're under 59 and a half or 55, let's say for technical reasons, that's an illegal. It's
just a transaction. It's a distribution. It's a premature distribution.
That's what it is.
And a premature distribution carries a penalty from the IRS. 10% of the taxable amount. In this case, that would be all of it. And so you get to pay taxes and penalties if you're not old enough.
So I was just listening to you talk about this, Professor Plum. My notion ahead of time, and always kind of has been, but just as we're talking about it now, my notion has been that it's not generally a good thing. You were less negative about it, but
well, it's just a matter of how do you manage debt? How are you with managing debt? And when you've come down to the point where, and I'll tell you, back in the day, I used it to help pay for some college education at one point, and so I needed the money to pay for a couple semesters of school, and I looked at what are my options. Where am I going to get this money? It's decent sized dadgum bill. And so it's like, okay, I can use a credit card. No, I don't want to do that because the interest rates are just ridiculous. I can use an equity line, or could I? Because my kids went to school right after the housing crash, and I didn't have the availability of those equity lines then. So I'm looking at what are my options for paying this? Where am I going to get the money from? And it came down to that and I could afford the payment, and the 401k was the most reasonable source of capital that I could also pay it back. And I'm not one of those people that have my credit cards at the max where I'm going to worry about the fact that I'm never going to pay back anything. So I use the 401k loan. So, but I'm looking at, for anybody who's looking at it, what are your options? A, do you have to have this money right now? Or is this just something you want? Like, oh, I want to buy a new car. I can't wait. It's like, no, you probably can wait. Some people can't. Most people can. Start building up some cash so you can go do something. Car loans right now, they're probably about the same as the 401k loan. Probably 5-6%. I don't know. It's just a matter of what are my options? What other source of capital? Is it something that I have to have? If so, where are my sources of capital, and which one is the most beneficial to me? Sometimes if you have that equity line available, the equity line has a lower payment because it's stretched out over a longer period of time. Many times it's only interest only for a little while. So you have an easier cash flow time, even though it may be a longer payment.
And the rules, by the way, are less stringent. You don't have to worry necessarily about, if I have an equity line, well, if I leave my job, then it's not going to affect my equity line. And there's no taxable distribution going to happen.
And the interest that you're paying back in the equity line isn't deductible in today's world either. So it's not a tax situation one way or the other.
No, that's true. So I think what you're saying is that to determine whether it's good or bad, it's going to depend upon what is the money for? That's a bigger factor to you. And is there greater good in taking this money from the 401k and using it for whatever purpose it is? Is that a better deal for you than having to put up with all the potential negatives of a 401k loan? Is that about how you'd sum it up?
It's what is the best option. I mean, anytime I'm using debt, I won't say anytime, but many times, especially in this kind of personal debt, it's not, I don't have choices. And I don't like debt to begin with necessarily, unless it's some kind of positive debt that's paying me back, and this isn't what's happening here. It's just a matter of what's the most palatable form of debt. Understanding that I'm giving up the growth opportunities that are in the 401k for the amount of money that I've borrowed. Understanding that I've got a 5-year payment, so a decent sized payment that I have to make over the next 5 years. Luckily, it comes out of my paycheck. I don't actually write a check to them. It just comes out of my, it's one of the salary deductions, just not a tax deductible one. And so it's just, what is the most palatable form of capital that I can use to do whatever it is I'm trying to do? And do I really need to do that right now?
Compare this for just a moment, the 401k loan. There are also options, and nobody brought this up on the email to us, but I'll just bring it up now if anybody's thinking about it. There are these hardship withdrawals that are sometimes available to people. Can you just address that for a minute too?
Sure. If you qualify for a hardship, you can take a withdrawal from your account, but that's a taxable event. And if you're under 55, 59 and a half, well, 59 and a half because you're still working, it's penalized. So normally you don't want to do a hardship withdrawal because you can't get the money back in. It's all taxable right up front. And that takes away some of the ability to use some of the money because you lost some of it to taxes. So hardship distributions are tougher to deal with. Plus, in many plans, I'm not sure if it's a law, but I've seen this happen most of the time. If you take a hardship withdrawal, you can't contribute to the 401k for a period of time either, because they figure, well, if you're doing hardship, you're in hardship.
Yeah.
So I like the loan, idea more than the hardship withdrawal in most cases.
And that's why I wanted you to just address it. I'm not going to get really into hardship too much. But
in the worst case is you can't make the payment back in a couple of years, and it turns into a distribution, which is kind of like a hardship withdrawal anyway.
Well, and
so you're just postponing the tax to where it may be a better time or less of a penalty, less of a taxation.
So your plan needs to allow these things. If you're considering doing a 401k loan, the plan first of all needs to allow it. And if they don't, then that's just not going to not going to happen. But I brought this up because there are something like $9 trillion sitting in 401k plans as of the early part of this year. And I mean, that's a lot of money. And there are people who say, boy, most of my money is, most of my net worth, most of my portfolio is my 401k. And I got a ton of money in there. And, I'm just kind of would love to access that in one way or another. Using a 401k loan is probably...
it's not the greatest thing, because I don't want you to think that I'm really in favor of them. I'm only in favor of them if there's no other choice, or if that's the best of bad choices. Because you are potentially taking away, not as bad as a distribution, but you're taking away some of your ability to retire, if you don't do it right. And unfortunately, people can mess them up. They lose their job, they get paid, it gets expensive real quick. And I hate short changing. Most people that get to retirement that have large 401ks, it's a point of, wow, I'm glad I didn't screw that up. At least I have this for retirement.
Well, and this also, it's not the same thing, but you have similar considerations, I think, when you're doing, we haven't talked about 72T distributions in a long time. But when I hear you saying these things that could trip you up, and you wind up being worse off than you were in some ways before you did it. And we're not going to get into 72T. That could be another show. But Professor, I'm sensing the same kind of thought process that you need to consider.
The best option of the worst options that I've got. I'm in a position where I don't necessarily want to be. I got to pay this big bill. I got to do this. I'm retiring early, and I need to find some cash. That's where the 72T comes in. It's a matter of, what are my options, and what is the least worst?
If I could figure out a way to because that's another thing we haven't talked about, and the reason we haven't talked about 72T is because it's just kind of dry, and
Well, the good news on 72T, now 72T is one of the exceptions to a 10% penalty for taking an early distribution from a 401k, IRA, a tax-deferred retirement account. Mm-hmm. And for a long time, ever since 2020, it was a calculation to determine how much money we could take out of the plan, and it was based on current interest rates. And current interest rates were basically zero for a long time, and so the payment from a 72T was relatively small. Mm-hmm. We just couldn't get any money out of a 72T to make it work. So even if somebody wanted to retire, it wasn't enough money to retire on. If they wanted to retire at 53, 54, 55. And then in 2020, I think it was Secure Act as well, but right about that same time, they came out and said, okay, hey, we understand that the interest rates are zero. We'll change the wording of the law and say you can use the higher of current interest rates, what they call the applicable federal rate, or 5%. So 5% now allowed for a better payout. And right now, the rates are even higher since the interest rates are higher. But so 72T could potentially be coming back in vogue a little bit for people who are retiring early. It's just that I don't think there's that many people looking to retire early or looking to create an income stream from their IRAs at 52, 53, 54.
Yeah.
It's just, there are ways around it when you're 55 if you have a 401k. It's because there's different sets of rules for taking distributions from an employer that you terminated from at 55 versus the IRA at 59 and a half.
Yeah,
to avoid penalty.
And it gets kind of wonky here. If I can figure out and we won't do it next week, but if I can figure out a fun way to talk about further distributions without penalty,
a fun way,
maybe we'll talk.
You're talking about tax code and penalties, and you're also trying to make it fun?
I've found that if you just sound excited about a particular topic, you could talk about just about anything. But it's very hard with things like this. The thing on the 401k loan, and as we wrap it up here, because so much money is sitting in 401ks, and I did another search, and there are a lot of people asking about, not just this program, but a lot of people asking about 401k loans, and I wanted to bring this up. If you need some advice on this stuff, Maybe what are your options? Professor Plum just discussed a few of them. I would suggest you give the advisors at Lucia Capital Group a call, 800-644-1150. It's not just about taking 401k loans, but what are your other options with your 401k? There are a lot of things we could talk about, Professor, with regard to a 401k. And I don't want to keep hammering 401ks or hammering the same topics, but there are a number of topics that we haven't even really addressed with 401ks, and yet so many people have them. It may be something to consider in the future. Can we make that interesting?
We can try.
All right, we'll try. 800-644-1150 is the number at Lucia Capital Group, as I said. Or you can go online. You can find them at luciacap.com, LUCIACAP.com. Find all kinds of blog posts and videos and white papers, whatever else is there. If you want your questions answered, you can go get it there at luciacap.com. Don't forget to subscribe to our podcast, Apple Podcasts, Spotify. Those are the two main places you can find this podcast. Subscribe to it. Get each episode downloaded to your device every single week, and do not miss any of this. I really enjoy doing these podcasts, Professor Plum. I keep thinking, am I still going to be doing these when I'm 70, when I'm 80? And I'd like to say yes, because I really have a lot of fun doing this stuff. I hope you do too.
Well, for me, 70 is not that far away.
That's why I changed it to 80. When 70 is still 9 years for me.
You're a little closer for me.
You're a little bit closer. Maybe we need to talk about topics that are much closer to home for you and me, which for years, age 50 or older to me was a long way away. Well,
now it's a long way behind you.
That's so far in the rearview mirror, I can't see it anymore. I thank you, Professor Plum, certified financial planner, professional, and accredited wealth management advisor. It's been a lot of fun. And for Professor Rick Plum, I said CFP, registered trademark, I'm your podcast host, Johnny Dean. Appreciate everyone being here. This is Managing Your Financial Future. We'll talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There's no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Before investing, carefully consider a target date or mutual funds investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. A dollar cost averaging strategy does not guarantee a profit or protection from loss. You must consider your willingness to continue purchasing during periods of high or low price levels. Rick Plum and R.F. Friedman are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.